do until 3 days ago is now possible, and that will change our world a little bit. Good morning, Grand Energy. Asher Leeds, Doji, RJ in Texas. We're going to dive into this. People are going to come into the room, and we can give them a couple of minutes, but let's move this up to the front. We're going to move this up to the front in the morning because it's a lot of filler. It's just a reminder, hey, here's what you got to look for today. Here's kind of what the noise will be around. Let's start with the noise before we dive into the things that actually matter. Well, 10 o'clock, we got a retail sales update. Most important retail sales in the history of the world, right? December, we'll talk about what happened with the holidays. I don't know, 45 days ago? Who cares? Markets are not supposed to be doing that. We're going to be going backward in time. Fed, Hammock, and Logan will speak. I want you to pay attention to what Lori Logan has to say. We will see if she mentions the SOFR, the Secure Overnight Funding Rate, which is what the Fed has been aiming to defend with its $40 billion injections. We have non-farm payrolls coming up tomorrow. CPI on Friday. 3-year Treasury supply in focus as well. KO. You may know that as Coca-Cola. Just absolutely blowing the doors off the market in recent weeks. Well, pull back at 3.7% to start the day. GILD, which is going to be a very critical name to be watching because of momentum and where the stock has been. And we got a nice little thing for you coming up today. Outside of the runner, a new list that we want to add into our morning conversations and into opening bell. After the bell, Robinhood, Diet Clown Death, AIG, Ford, Datadog. AIG is going to be critical, obviously, given the fact that we have been paying so much attention to the repo market. And resistance, that 69.80 level is a key line in the sand for the markets. It continues to try to push to back above that level, and it cannot find that support. All right, so the big question is, how do you quantify a situation where the S&P 500 squeezes higher over 2 days, bouncing off that 670 level on the SPY, running all the way up toward that 690 level? And how is our reading? Remember, number of stocks breaking out versus breaking down at -2. Aha. Aha. What's that from? Oh, Coming to America. Aha. The answer is weight. And down here, what you're going to see is a weighted average. This is something that we haven't been able to do in the long period of time that we have been operating. So what we're seeing at this very moment is a apples to apples comparison of the S&P 500, which I've always used and has been extraordinarily predictive, by the way. Every major downturn that has transpired since COVID, it hasn't mattered if it's weighted or not. It had really all that has mattered is the number of stocks breaking out versus the number of stocks breaking down. But the cap weight, the fact that I can add that now, the fact that I can add trillions of dollars sloshing around directionally, combining that with the number of equities, and then specifically looking at what are the specific stocks that are taking us in a very different direction. It's showing us divergence. It's showing us that the number of stocks moving higher are going lower, but the point is that institutions are selectively purchasing. So we have 19 stocks breaking out, 21 breaking down. I'm going to take you through that list in a little bit. 270 stocks on the S&P 500 are technically in the green, 120 in our readings on the negative, but it's where we bring those top names up, high scores. That's where this figure really works. We're at -2, but our weighted is 0.57. 0.57. Or forgive me, 5.7. See, I don't know how numbers work. Russell is at 14, while the apples to apples is -40. This is where the big divergence is here. The head count is terrible, but the cap weighted is screaming green at +15. That means big money sees something in that small caps do not. So we'll be talking about that momentarily. Right now, as we look at this, S&P 500 now currently sitting near its all-time high. The NASDAQ is confirmed still bearish. That's the story. S&P and Russell showing some institutional money still buying as more names break down. So we want to watch that divergence and just be cautious. But the key thing here is the question everybody asking, is the K-shaped or V-shaped recovery rebound? Are we seeing broad participation, or is this just the mega caps dragging everything higher? The data this week, remember, retail today at 10, weekly ADP tomorrow, ECI today, NFP on Wednesday, CPI on Friday, CPR necessary, DGTM, Q, R, W. It's too many letters. 79% of S&P 500 companies have beaten expectations this so far. The 10-year yield is at 4.2. That's what we're going to be watching. Money markets are pricing in 2 rate cuts for this year. Very important, right? And the bond market is telling you something different than the stock market. So pay attention to that spread. And we'll continue to dive through this. There's going to be a lot of noise this week. I think the bigger story remains the same story that we talked about yesterday. Gianni and I have been talking about this. The yuan is breaking out. What? China. We are witnessing a great divergence in the world. Some people have said, explain. Okay. Back in the 15th, 16th century, there were 2 mega powers on the sea, Spain and Portugal. And they agreed to divide the world in half. Spain took the Western Hemisphere. Portugal took the Eastern Hemisphere. Ask Japanese people how they feel about the Portuguese. Not good. You can also watch Shogun if you need anything on that. But the point that I'm making here is that is kind of how the world is being split up right now between the United States and China. China did nothing when the United States went in and grabbed Maduro. They probably will not do anything around Iran as well. We are witnessing this big shift. And Ray Dalio, bless him, said last week there may be a capital war. He's been warning about capital war since 2018, 2019, but we're in the middle of one. And China has said, dump your treasuries to their banks. This is important. This is important. It isn't just diversification, it's a strategic move. They're repatriating capital back into Chinese assets. So watch the equities, watch the weighted equities in the Chinese markets, and we're going to start to look at how their stimulus impacts their equity markets. They're adding roughly 3.2 trillion yuan into their economy while they're selling treasuries to defend their currency. That's very interesting, right? Because if you're engaging in stimulus, that should weaken your currency. But here's the thing that I want to point out. The slides are always available. We will have them for you. The key thing to keep in mind is that when countries engage in stimulus, quantitative easing, or something similar, it actually drags money back. The United States has done this multiple times since 2008, and it is a paradox in markets. And I want you to remember this, because when the United States has to do its next round of QE, the S&P 500 is going to move much higher, and foreign capital is going to flow back into the United States. It sounds like a paradox because you should be technically weakening your currency at home. But what happens is it leads to valuation expansion as people chase finite equities, smaller number of stocks. So remember this, as China is printing, their yuan is getting stronger, interestingly enough. It's a paradox. But that said, it's leading money home. So we're going to start to watch key technical levels on Chinese stocks, on CWeb, on companies like Weibo, Alibaba. And we're going to ask Gianni about this as well, because I know that he has been bullish in the past on China. The question is, how does this translate into momentum trades that you can make outside of the United States in an equity market that seems a little bit complex, but really does operate heavily on momentum? Gold's back above 5,000. Oh boy. I don't know why anybody thought this would be any different. It's holding at 5,000. Oh, after that January 30th sell-off, 5,000 an ounce. That was unthinkable 2 years ago when we were down around 2,100. The Bank of China is hiking its margin requirements on gold contracts starting tomorrow. That is not bearish. That is regulators trying to cool off a red-hot market. On the other side with commodities, key things to focus on right now, WTI above 64, Brent above 69. The Amoy refinery is offline in Venezuela, caused by a power blackout. Natural gas still continuing to pull back from that storm surge that we saw a week and a half ago. A reminder, when you see the S&P 500 or anything, go look at the UNG, right? UNG, that is the natural gas futures contracts. Two times we have moved into overbought territory up around 17. And both times it pulled back violently. This is the importance of understanding how relative strength index and money flow index operate. These are very important things to recognize and understand. When we dig into this, we'll pull this up right now. One of the things I want you to be focusing on when you look at something like the UNG, and we bring this down to a daily chart, okay? What you are specifically looking for, you're going to go to your little studies. You probably can't see this, but you can follow pretty simplistic directions. One moment. Let me unscrew this wedge. You're going to see my whole screen and all the chaos that comes with it. It's going to be fantastic. See, look, there you are chatting with me in the chat. It's an exciting time. We're going to can all this stuff. We're just going to add the relative strength index. Okay? And you're down here, and you're going to look at your daily charts. You see these pops. We would probably have to bring this down to the hourly. When we get stretched like that, that is your contrarian opportunity. That is your contrarian opportunity to go in the other direction. RSI pushing toward that 80 level, 70 level. Don't be afraid to bet, even in the face. I need a lot of things. Doji. You want to send me one? You just send me one. Just send me one. Here, I'll give you an address. I have so many broken monitors over here that I have either had fall off my desk, get hit with a baseball while watching baseball. I need a lot of things. We are in a new house, and we have not done anything with it yet. Chinese holding worthless paper issued by communist. Okay, well, I don't know how to break it to you. All fiat currency is not doing too well. Let's wrap this up. Fed with the Trump with the Fed. Fed up with Trump. Okay, let's stop. Trump is back on the war horse right now, talking about Mr. Powell, calling him incompetent, calling him corrupt. I'm over this. This is largely noise. Could not care less. He's escalating attacks on Powell. Mirren's saying that we should move rates lower. Cuts are priced in. I don't care about any of this. The key thing that I focus on is I want you to recognize that there is a Twitter meme out there, and I want you to just recognize, that's why I brought this chart up. There's some things going around saying that Trump already regrets his nomination of Warsh. That interview, that line, is Trump saying that he regretted not making him Treasury Secretary, Fed Chair back in 2017. Two different things. Just be aware of that. Earnings in focus, you got Spot. Interesting. Huge change in the policies by BP. BP has cut its entire buyback program, suspending its buyback program. Stock is down 5%. Don't be shocked to see this thing really start to cave. And on the other side of that, we have to have a conversation about whether or not U.S. major names, the big companies, the Amazon, the Apples, the Amazons, all of those companies, if they suspend their buyback programs and if they shift to allocating all of that capital directly to AI and CapEx build-out. Why does that matter? Buybacks are a significant portion of stock market returns, especially since 2008. And we are seeing a lot of those big companies start to shift toward negative cash flow on this AI build-out. They can either borrow money, which could be very problematic this year during a refinancing curve, or they can cut their buybacks and allocate that cash flow directly. That may be coming. That may be coming in the next 2 quarters. So just be aware of that. Retail sales. Hey, everybody loves that. I'm bored. All right, let's move on. APH. And we will go from there. And we're going to go buy a bunch of monitors today. We're going to do all kinds of things just for Doji. 16 monitors. 17 monitors. Let me add some things to my chart before we do that. And then that way, I don't get yelled at. I don't like getting yelled at. Exponential, exponential, exponential. Stop. See, there's all types of things. And people are going to say, hey, let me tell you how to do this. And I'll say, we'll figure it out. It's fun that way. It's just chaos. We just get it wrong, and then people say you're doing it wrong, and we all learn. That's all that matters. We all have a good time. Sometimes the real lessons are the friends that we made along the way. All right. So, APH, what do you do? I don't know. So, APH has been on the move. This is one of those Amphenol names tied to the gold trade, and that's where our focus will remain. There is no reason not to anticipate more pressure on these stocks. So to the upside, this stock has just pushed above a key moving average, a 20-day of 143.83, 50-day at 141.40, and the 8-day at 142. Pretty simple. Sell spreads to the downside. Look for an 80% probability of profit. Look to continue the trend where you buy in the money and sell out of the money doing a call spread. Pretty nice little thing that you could look at, see what we've got here. Spreads aren't that bad over here on APH. And looking out to that 145 level, clearly telling us that earnings are coming up. But that's why you want to potentially shift to that February 20th period. So February 20th is where we're going to be looking. There we go. And not a whole lot here, but again, you could buy the 140 for February 20th and sell the 150. And that creates an interesting trade. And that's going to be our trade idea of the day for APH. Buying the 140, selling the 150 for next Friday. That gives you 10 days of momentum. Not that complicated. February 20th. So about $7 on the 140 and about $210, $220 on the 150. And what that's going to set you up with is about a $490 trade to make 510, about 104% return on risk, 55% probability of profit. Here and there. Okay? Nailed it. Win. I don't know how this is even a thing, but we're starting to see, once again, some little bit of optimism, hopefully, from some of these names. Win has been beaten up pretty badly in recent weeks, coming up for that 133 from that top in December, but like other names, have been squeezing. So same type of thing with Win. I'm not selling spreads on something like this. We're just simply looking for a potential rebound here. And then on Citigroup, which has been odd to see some of these banks moving higher. Citigroup is still historically cheap compared to a lot of its other rivals. But Citi, I'm a little, it's really the fact that they're providing ample support to the banks through the reserves. So you might want to take what the market gives you and look to sell spreads on Citi down around that 110 level and even lower. All right, to the downside, Google, Payo, and Play. I just saw an ad for this company yesterday, and I thought to myself, I have not been in one of these in 15 years. And then I wondered, why was I in that 15 years ago? Was it because they were selling beer for $1? Maybe. It was the Chicago Dave & Buster's. I don't even know if that's a thing anymore. 1820 EMA of 1918. It's the 50-day EMA that we're paying attention to at that 1840 level. And what you're going to do here, buy the 19, sell the 17, sell the 16. Looking for a revisit of that $16 level, keeping a tight stop. What's my view on MU? Strong. Still bullish on MU. We've been selling spreads on it for a while now. But once again, the names are still under pressure because of momentum. So I want you to just understand that when we look and talk about things like MU and Micron, the selling that we just saw had nothing to do with the underlying stock itself. And I want to just remind people of this. Let's go back to when NVIDIA sold off 33% back in August of 2024. It wasn't because the stock thesis changed. It was because we had a major macroeconomic blowout tied to Japan. The stock fell 33% in 3.5 weeks. Micron can do that too. Micron will do that too. So it's important to note that when momentum is negative, you just kind of hang out. You hang out. If you want to own it for the long term, own it for the long term, but recognize valuation compression is likely going to hit some of these names. And when there is an unwind in leverage, these are the things that go. This was the worst momentum day in 7 years that happened last Wednesday. It's not like anything changed with Micron. Still a major, major, major player and major catalyst, right? And the semiconductors and the actual hardware are outperforming the software by a massive level. So recognize the stock for what it is. It is a hyper-leveraged equity that is owned by many different players, passive flows, leveraged players, and retail. And when these things unwind and when our signal goes negative, it gets its head kicked in, as does probably anything else in the S&P 500 at the top. Other things to watch today, NVIDIA is breaking. It just continues to go, and I think a lot of this has to do with the fact of the relationship between NVIDIA and just the strength of what's happening in Japan. NVIDIA is continuing to break out, and I continue to note, if you're going to trade it, and you're going to day trade it, pull up things like the NVDL, trade the NVDL, use volume-weighted average price, look for reversions and reversals. There's a lot of opportunity in NVIDIA right now. It is at all-time highs. It's within like 15 points, right? So the NVDL, which is the double long ETF, these are the types of things that when I see flow come into it, I'm willing to buy it. I'm willing to trade it. I'm not going to, I'm willing to hold something like the NVDL for more than a day or two and just keeping tight stops even post-market. There's your volume-weighted average price for the NVDL. NVDS in the other direction. You can short the NVDS if you wanted to. These are the leveraged ETFs tied to these names. Palantir. Yeesh. It's back, isn't it? And we got to get to the last part of this, last 10 minutes. I want to just highlight something. But Palantir, continuing to just do what it does. It's coming off a relatively sizable sell-off. Again, a lot of that leverage coming out. Technology remains under pressure, and it's trying to wake up. This is that bottom that Goldman tried to call the other night. But for right now, it seems like it is stuck in a process of lower highs and lower lows. Where would I buy Palantir? Where am I willing to step back in? From a trading perspective, it's not that complicated because eventually there's going to be that breakout. I am looking specifically for an 8-day crossover, 8 EMA over its 20-day EMA. So that is about $2 to $3 away. I want to be buying into strength. That 20-day moving average is currently sitting at about 155. It will be dropping at the same time that the equity would be climbing if we can get to that point. That's going to be somewhere around like the 148.90 level. where I'd be looking. So Palantir moving after analysts deem software as a service sell-off overdone, and Barclays sparks rotation back into sticky software incumbents. Whatever you say, bud. I'm just going to say it all comes down to liquidity. All right, we're going to wrap this up. What's FDX's excuse? Well, they're buying InPost for like cheap too, aren't they? I want to get to the end of this. All right. So I've said a couple of times that I'd been looking for a way to quantify a lot of this stuff for, I don't know, 6 years. That's your reading here. And let's, if anybody wants the slides, Scott, can you throw them in? That's our reading, right? And I've said a couple of times, like, what we're accomplishing here and why this thing is relevant and why it matters. One, every time that this does go negative and does so out of nowhere, it typically aligns with a sizable move down. Not every time. Sometimes it's just a retest of that 100-day moving average, which is what we just witnessed on Thursday. But I will note, and if you can go back and you can check the tape, you can do it over and over again, because this is, I want to say this is like the 6th time this has happened. If we look at our daily readings, and we talk about our daily readings, remember, I have said in writing, and I've said on our show multiple times, we can go back to January 12th. And when we go back to January 12th, you'll recall, I hope, that I said that momentum was the strongest it had been since October 18th. Now, why does that matter? And that was back here. Here. Right? One sell-off, and then chop along the way that has led us. We've moved into this kind of volatile environment. The last time that this went really negative, and it went negative, was July 28th. So we've had that move. We had that predicted pullback. We've squeezed again. But here's the problem with retail. You get a move like this to this, and everybody starts throwing in the towel. And we squeezed up again, no doubt about it. We squeezed back up again, and it's one of the reasons why when we anchor, we want to anchor to previous lows. And then we look for institutions to run things back up, or just short-term squeezing. This figure that we have is a measurement of stocks to 1-to-1, right? But we've added the weighted cap, and what we're specifically looking for, which is critical, we're analyzing volume, we're analyzing various specific momentum conditions. And when this moves, and when it moves quickly, bad things can happen. And then when it goes positive, we squeeze again. Now, what are we actually analyzing? We're looking at the bell curve. These are the stocks that are leading the charge on the academics. This is all academic. There's plenty of analysis out there. There's plenty of data out there in the ecosystem. These are the stocks that have been leading the signal, and these are the stocks that are on the other side of that. And our job is to identify the stocks that are just starting to break out. Things like, RMD. RMD just joined this list. It's all the way at the bottom, and its relative strength is not that bad. It's only at 68. A lot of these names are overbought as can be. But strength creates strength. Combining, adding weekly and momentum percentages, these stocks are in extraordinary breakout mode. And the way to potentially trade them is pretty simple. Take the stock, set its stop back at, 2%. Or wherever you open, the bottom of the range on volume-weighted average price. These are the stocks that are going to squeeze if momentum turns positive again. It will be Hood and KKR and Coinbase and Blackstone. It will be FDS, FactSet, and PayPal. These are the stocks getting their heads kicked in. But the moment that these stocks fall off this list, that's where we look to squeeze. And the moment that these stocks fall off the screaming list, That's where we look for them to go the other direction because they are extraordinarily overbought. These are the momentum stocks right now where there is ample institutional support, and it has been there for at least a month. So these are the things we're looking to continue the trend, but the moment that they fall off this list, well, that's where I'm looking to go the other direction. On this other side, I'm waiting for this market to say, all right, the worst is in on crypto, and a lot of these things that are being shorted, well, we look for them to squeeze and come out of oversold territory, which is on the far right. This cap score is critical, and this is something that I haven't been able to do 6 years. This cap score is showing you that institutions are selectively choosing the names that they are crowding into. On an apples-to-apples basis, this score has knocked it out of the park for years. But that cap score turned positive on Friday afternoon. Why does that matter? It matters because it's suggesting that the S&P 500 will continue to move higher, even though the underlying breadth is negative. So I've got this list. I've got a big list. And here's the other thing. TER was a name that we had been talking about. TER had been on a run, Teradyne, for weeks. It has run since a positive crossover on its MACD back on January 27th, 230 to 309. So what does it mean? What does it create? What are the things that we're going to be looking to do from an academic perspective and from a opportunity perspective? What we want to start to do is incorporate and take all of the stocks that are in positive conditions. There are 270 of these. We want to find an elevated RSI, and we want to see a positive MACD crossover, and we want to see if these are the names that will ultimately lead this list that help us get into this predictive figure. For right now, before I were to short this market, I want to see this cap score turn negative because, again, that is a weighted average. And the way that I want you to think about it is there may only be 19 stocks on this list on the left versus the number on the right. But imagine that they're playing tug of war 19 to 20, and at the end of the 19 are two very large young men who just happen to weigh more than 5 or 6 of these crashers combined. So it is pulling the bell curve into positive territory, and that cap score is going to be absolutely critical moving forward, something that I have accidentally stumbled into, and something that I will be back testing and analyzing over the next couple of days. All right, so yes, we are green. We are heading into an interesting afternoon. Bullish by dollars, bearish by head count, financials dominating, and that's the other thing to note. Look at what is moving higher. Look at what is running. Healthcare, industrials. That industrial showcasing, once again, that strength that we are seeing in the Dow. It is the financials that are getting beaten up. A lot of insurance, a lot of crypto. What does cap score stand for? Weighted. It is weighted. It is a weighted cap score. So instead of just measuring the number of stocks breaking out versus breaking down, which is what this is, we are weighting the score in terms of dollars, in terms of market capitalization and flow. So once again, what it's telling us is it's showing us issues with breadth. It's showing us that just a smaller number of stocks are doing the heavy lifting and pulling this equity market higher, even though the underlying current suggests weakness. What does EW and cap scores do? EW is equal weight, and cap is weighted cap. And Mark's already built his own score. Look at that. All right, so we'll keep an eye on that. We'll look for updates on this as we go. If this rolls over and this cap score starts to go negative, it is a combination of capital and number of stocks breaking down. And a lot of this can be tracked on the aggregate on Thinkorswim. I will ask Blake to show you where to do that. All right, that's it. We're going to wrap it up. It's going to be fantastic. Don's coming up at 9:30. I will be back at 3 o'clock. I hope everybody has a great trading day. stick around. We will catch up in a bit. Is the cap weighted on the S&P 500? This is only the S&P. We have readings for the NASDAQ, readings for the Russell. The Russell reading, before I go, Russell reading -40 on equal weight, plus 14 on cap. So once again, small number of stocks doing all of the work, and that is represented in these weights that we have talked about in the past for screeners. All right. It is one of my metrics. I hope you guys have a great trading day. We'll catch up in a little bit. Don's coming up right now. Take care.
I step off the train, I'm walking down your street